In a heavily guarded room deep inside Moscow, a quiet decision was made. No press conference, no televised announcement, just a single line buried in an obscure government release, yet powerful enough to rattle the global financial system. Russia is selling gold. A nation under sanctions, a nation cut off from Western finance, a nation whose reserves are more than 40% gold, is now quietly pushing that gold back into the market. And instantly, a wave of questions ignited around the world. Is Russia running out of money for the war? Are they turning their back on gold? Is this the beginning of a global gold liquidation? The headlines spread like sparks looking for dry grass, right at a moment when the world already feels dangerously unstable. In Japan, the yen is sliding to levels no one thought possible. In the US, inflation is climbing again. Crypto is bleeding red. Tech stocks are trembling. There's a strange tension in the air, like something important is about to break. But here's the twist, the part almost no one is paying attention to. Even as fear spreads, gold and silver aren't collapsing. They're holding up better than almost every other asset. So what's really happening? Why is Russia selling gold, yet gold refuses to fall? To uncover the truth the headlines don't want you to see, hit that like button, and let's begin. At first glance, Russia selling gold in the middle of a war feels almost absurd. This is a country cut off from Western banking, barred from using dollars and euros, and squeezed by some of the harshest sanctions in modern history. In a moment like this, gold should be their lifeline, the one asset untouchable, unfreezable, unimpeachable. Gold is supposed to be the oxygen tank you cling to when the world seals off every other escape. So why would Russia sell it, and why now? When Western media jumped on the headline, Russia selling gold to fund war losses, Russian reserves under pressure, the story seemed straightforward, clean, comfortable. But that neat little narrative had one problem. It wasn't true. Russia isn't dumping gold. Russia isn't shrinking its reserves. Russia isn't abandoning the metal it spent years accumulating. What's actually happening is far more intricate and far more strategic. Economists have a quiet name for it, the liquidity loop. And it works like this. Step 1. Gold is withdrawn from the National Wealth Fund, a vault designed to hold Russia's most important long-term assets. Step 2. That gold is handed to the central bank. In return, the central bank prints new rubles and wires them to the government to fund domestic spending, including, yes, the war effort. This injection of money should cause inflation, but Russia has a counter-move ready. Step 3. The central bank then sells a portion of that gold inside the domestic market. Everyday Russians buy it using rubles. Rubles that are immediately sucked out of the economy. Less money in circulation means less inflation pressure. And here's where the loop snaps shut. The central bank uses those collected rubles to buy freshly mined gold from domestic producers, quietly funneling it back into national reserves. By the time the cycle completes, three things have happened. The government gets the liquidity it needs. Inflation is kept on a leash. And Russia's gold stockpile ends up right where it started. A closed circuit, internally recycled, externally invisible. None of this gold reaches international markets. None of it impacts global pricing. None of it signals a shift in Russia's long-term strategy, which leads to one unavoidable conclusion. Those dramatic headlines were noise, nothing more. Russia isn't selling gold to get rid of it. Russia is selling gold so it can keep it. A paradox on the surface, but a clue if you read between the lines. Because if Russia isn't putting pressure on global gold prices, if their actions are contained entirely inside their own borders, then what exactly is shaking the global market? To find that answer, we have to follow the only force that truly matters in finance, the movement of big money, the great rotation happening in silence. There is a rule in finance that never fails. Big money always moves before big news. And right now, a massive flow of capital is shifting. Quietly, silently, behind the scenes. Most people think the rotation is happening between trendy assets, gold to crypto, or gold to tech stocks. But that is not the real story. The real rotation, the one reshaping global markets, is happening inside the largest asset class on Earth, government bonds. For decades, bonds were considered the ultimate safe haven, the place pension funds trusted, the place nations stored their wealth, the bedrock of global finance. But since the pandemic, everything changed. When governments printed trillions, when central banks launched the most aggressive rate hikes in 40 years, When debt exploded, bond markets quietly broke. Because there's one uncomfortable truth economists rarely say out loud. When a government prints money to pay its debts, its bonds lose real value. And governments are printing a lot. So, institutional investors, sovereign wealth funds, pensions, central banks have started backing away. Not loudly, not publicly, just quietly stepping back. A silent exodus. But the money doesn't disappear. Money never disappears. It moves. And it's moving toward assets that cannot be printed, cannot be sanctioned, cannot be frozen by another country's central bank. Gold and silver. Not because they offer high returns, not because they're trendy, not because they're exciting, but because when the foundation of the monetary system feels unstable, only assets outside that system feel safe. And here's the part the media almost never mentions. Central banks are currently buying gold, at a pace not seen since 1967, the year the world abandoned the London gold pool, and gold began breaking free from fixed prices. This is not small money. This is not speculative money. This is not retail money. This is sovereign capital, the deepest, slowest, most informed capital on the planet. Capital that only moves when something huge is shifting beneath the surface, and that shift is what brings us to technology, to crypto, and to the wake-up call that hit markets in 2025. For years, markets lived under one comforting belief. Technology, especially AI, will save everything. Nvidia became the symbol of that belief. Its stock soared. It crushed every earnings expectation. It became the miracle child of Wall Street. And last week, Nvidia reported results so strong, they looked almost unreal. Revenue up, outlook is stronger. Shares up 5% in pre-market trading. It should have triggered another melt-up, another leg higher, another wave of optimism. But instead, the opposite happened. Nvidia fell nearly 6% for the week. It dropped 14% from its 2025 peak. It pulled down the S&P 500 and the Nasdaq with it. Why? Because markets don't react to the past. They react to fear about the future. And right now, the future of AI is clouded, not by technology, but by economics, higher capital costs, slowing margins, and overstretched valuations. Crypto suffered the same fate. The easy money dream of 2024 collapsed. Bitcoin dropped 30% from its 2025 high. Ethereum dropped 40%. Dozens of altcoins simply vanished. The air came out of the bubble. And yet, in the middle of that storm, gold and silver fell only about 7%. Not soaring, not crashing, just holding, steady, resilient, unmoved by the chaos. Investors began to realize something uncomfortable. The asset they wanted, tech and crypto, was not the asset they needed. The need was for something that holds value when almost everything else melts. And that realization set the stage for the question almost no one wanted to ask. In the last 5 years, what asset actually won? From 2020 to 2025, we lived through one of the wildest periods in financial history. Record money printing, runaway inflation, exploding interest rates, war, supply shocks, a massive AI bubble. But beneath all the noise lies one simple question: who actually won? Crypto? For a moment, yes. Tech stocks? For a moment, yes. The S&P 500? For a moment, yes. But when you strip out emotion, hype, and temporary gains, and look only at the data, if you invested the same amount every month into silver, gold, and the S&P 500, over the last 5 years, your returns would look like this: silver, 81%, gold, 79%, S&P 500 with dividends, 59%. The truth is harsh and quiet. Precious metals outperform the strongest stock market in the world, even before a major crash. Gold and silver didn't flatter anyone. They didn't promise 10x gains. They didn't trend on social media. They just rose, slowly, steadily, unapologetically, and that's before the real storm hits. The one many economists believe is still ahead. If gold and silver have already beaten the S&P without a stock market collapse, what happens? When a real correction arrives? To find that answer, we need to look at a place long considered the epitome of stability: Japan. For decades, Japan has been a symbol of order, a nation defined by discipline, efficiency, and financial stability. A place where things simply worked, where prices barely moved, where the currency was a fortress. But today, that image is cracking. For months, the yen has been slipping, then sliding, then outright plunging. Everyday goods, rice, milk, electricity, transportation are rising in price. Families who once felt protected by a stable system are now running into pressures they've never experienced before. But the real shock didn't come from markets. It came from Tokyo itself. In an attempt to support citizens facing inflation, the Japanese government announced a stimulus package worth hundreds of billions of dollars. On the surface, it sounded compassionate, practical, even responsible. But economically, it was the worst thing they could have done. Because stimulus means printing money, and printing money while your currency is collapsing is like throwing gasoline onto a fire you're trying to extinguish. A brutal feedback loop begins. The yen weakens, prices rise. Prices rise. Government hands out stimulus. Stimulus, more money printing. More printing. Yen weakens further. A weaker yen, even higher prices. Around and around. A tightening spiral with no easy exit. But the part that should make global investors sit up straight is what Japan might do next. Japan is the largest foreign holder of U.S. treasuries. And when the yen falls too far, Japan has only one real way to defend it: sell U.S. bonds and convert the dollars into yen. If Japan sells in large volumes, even gradually, U.S. Treasury yields could spike, the dollar could come under pressure, and financial markets around the world would feel the tremors, from Tokyo to Frankfurt, from New York to Sao Paulo. And here's the more disturbing truth. Japan is not alone. Many nations are walking into the same trap. Mountains of public debt, weakening currencies, aging populations, and inflation that refuses to disappear. And when pushed into a corner, governments never choose to defend their currency. They choose to print. Every single time. This environment, one of monetary strain, weakening trust, and rising systemic risk, is exactly the kind of backdrop in which gold and silver have historically exploded. Which brings us to the projection analysts are quietly whispering about. In finance, there are moments when the surface looks perfectly still, so still that it almost feels safe. But beneath that calm, pressure is building, slowly, silently, until one day it breaks all at once. Right now, we're standing in front of one of those moments. Veteran investors, the ones who lived through the dot-com collapse, the 2008 meltdown, and the shockwaves of 2020, are all sensing the same shift in the air. Something big is coming. Not a tech boom. Not a crypto surge. Not another wave of speculation. This time, the driver is far more fundamental: the value of money itself. According to multiple economic models, the US may enter a critical phase early next year, possibly as soon as April, when real interest rates turn negative, inflation pushing higher, growth losing momentum, nominal rates unable to rise further, and real yields are slipping below zero. Every time in history this has happened, the reaction has been unmistakable. Gold doesn't just rise, it erupts. Silver doesn't just move, it accelerates. Now add the other ingredients forming in the background: capital quietly fleeing government bonds, currencies weakening across continents, central banks are buying gold at a pace not seen in half a century, geopolitical tensions simmering, inflation expectations are drifting upward, and the global cycle is inching toward monetary easing once again. Combine them, and you get a perfect storm. A storm that points towards something the mainstream still refuses to say out loud: gold at $5,000, silver at $80. Not as hype, not as fantasy, but as a logical response to a world under growing monetary stress. Stress that's been building quietly, under the noise, waiting for its moment. And that brings us to the final lesson. Financial markets speak in two voices. One voice is loud, fast, dramatic, attention-grabbing. That voice is noise. Noise says, Russia is dumping gold. The dollar is invincible. Rates will rise forever. Noise arrives early. Noise spreads quickly. Noise makes investors panic. The other voice is quiet, subtle, barely audible unless you listen carefully. That voice is a signal. And for the past 5 years, the signals have been unmistakable. Bonds are no longer safe. Fiat currencies are losing strength. Central banks are buying gold at record speed. Japan is telegraphing the future. Global equity markets are on the edge of a correction, and gold and silver, the ancient, slow, mocked assets, have quietly outperformed almost everything. The challenge for investors today is simple. Can you tell the difference between noise and signal? Because wealth is not built through panic trades or emotional reactions. Wealth is built through disciplined choices, repeated consistently, over long periods of time. So now I'll leave you with a question. If you had to hold just one asset for the next 5 years, gold, silver, real estate, or tech stocks, which would you choose, and why? Drop your answer in the comments below. I read every one. If you found this deep dive helpful, make sure to hit like, subscribe, and turn on notifications so you never miss a perspective that cuts through the noise. In a world filled with volatility, be the one who listens. Listen to signals. Listen to the truth. Listen to yourself. This video is for educational purposes only and does not constitute financial advice. Thanks for watching, and I'll see you in the next one.